Ram and Shyam were two friends who invested 5 lakh rupees with an annual return rate of 12%. Now after 10 years, both of them have a portfolio with a value of 15 lakh. Now when they redeem this investment, then Ram has to pay 1 lakh rupees in tax while Shyam has to pay only 9,000 rupees in tax. Why? Let's try to understand tax harvesting. So I have opened this Google sheet in front of you where I will help you understand that why Ram has to pay 1 lakh rupees and Shyam has to pay only 9,000 rupees. Okay, both of them invested the same amount, 5 lakh rupees, and Shyam also 5 lakh rupees. Now what Ram did is that he invested 5 lakh rupees with the annual return rate of 12% and for the next 10 years. So what Ram did is that he directly redeemed his value. He directly redeemed his value after 10 years. So if he redeemed this value directly after 10 years, then what will be the final value here? So the final value of his investment will be, you can have the original amount, multiply by 1 plus the interest rate, so that we can have the previous value plus interest. So we will have interest like this, 1 plus A3. So this, and to the power 10. So why I am doing to the power 10? Because it is for the 10 years. So I will write here A4. Okay, so this is here, and if I run this one, so what it will give me? It will give me this value. So this is the final amount that Ram got after 10 years. Okay, now if I subtract from this value, from this A5, if I subtract the original value A2, then I will get the capital gains. So this is the capital gains for Ram. Okay, now because this is the capital gains for Ram, so from this value you can subtract tax exemption, which is 1,25,000. So from this value you can have, let's say, so equal to A6 minus 1,25,000. Now this is the taxable amount. So this is the amount on which you will have to pay the tax here. Okay, now on this amount, if we try to calculate the tax here, so tax is what? 12.5%. So I will have this value A7 equal to A7 multiply by, so the 12.5%, because it is a long term capital gain, so that is why it is 12.5%. This 1,15,990, that is the exact amount which Ram has to pay after 10 years, because he directly redeemed his value after 10 years. Okay, now let's see what is the case for Shyam. So for the Shyam, what is the case? That he redeemed his value every year. Okay, he redeemed his value every year. So if this is the amount he invested, Shyam invested in first year, so after first year, what is the interest he will get? So the interest he will get here is A13 equal to A13 multiply by the 12%. So the 12% is 60,000. So that is the capital gains. Now this is the amount he redeemed. Okay, this is the amount he redeemed here. So what I will do here, this is the amount he redeemed. So he redeemed this entire amount, 5,60,000. He redeemed this entire amount here, 5,60,000, and this is the capital gains, 60,000. So what tax Shyam has to pay after 1 year? Equal to this B13 minus 1,25,000. Now see, because this value is negative, so you can consider as 0. Okay, that means there is no capital gains after the first year after tax exemption. After tax exemption of 1,25,000, no tax. So you can consider this as 0. Okay, the same thing will happen for next time as well. So what next time? For the after 1 year, what is the amount he will invest, Shyam will invest. So Shyam will invest here A13 equal to A13 plus B13. Now this is the amount Shyam will invest in the second year. So after the second year, what is the tax? What is the capital gains he will have? So this is the capital gains he will have after the next year. Okay. Then again, this is less than 1,25,000. So because this value is less than 1,25,000, so no tax for the second year. Okay. Then he will invest this amount. So B14 equal to B14 equal to A14 plus B14. So this is the amount Shyam will pay after in the second year. So you will keep doing it this thing. So like this. So third year, fourth year, fifth year, sixth year, seventh year, eighth year, ninth, 10th. Okay, like this. And then here you will have this amount here. So A15 plus equal to A15 equal to A15 plus B15. Okay, so this is the amount they have to pay. So once again, this is 0, this will be 0. Okay, and you can copy this formula like this. Okay, so you will have all of these values here. See, it has calculated all of these values for you. This is the tax they have to, this is the capital gains. This is the capital gains here. That means this is less than 1,25,000. So no tax for the fifth year. This is also less than 1,25,000. So no tax for the sixth year. No tax for the seventh year as well. See, 1,18,000. But after seventh year, from the eighth year, see, now they have to pay the tax. Now they have to pay the tax. Okay. So if we subtract this value, B20 equal to B20 equal to B20 minus 1,25,000. This is here, and I will do the same for remaining these ones as well. Okay, so for this one I will have here B21 equal to B21 equal to B21 minus 1,25,000. Okay, so this one here, and the same will be for this one equal to B22 minus 1,25,000 tax exemption. So I am doing tax exemption for all of these three here. So this is the value I am getting here. Okay, now you can add these values. This is the taxable amount. This is the taxable amount here. Okay, so if you add all of these values here, so equal to sum C13 to C32. Yes, so this is the taxable amount. Okay, so this is the taxable amount, and on this amount you can find that how much tax they have to pay here. So this is how they have to pay 9,000 rupees in the income tax here, and this is your tax harvesting.